Imagine owning 3 ETFs that could transform your financial future. Sound too good to be true? Well, over 80% of successful investors swear by them, and you should too. These ETFs are designed to help you build wealth, reduce risk, and secure your retirement faster. The best part? They're accessible to everyone, no matter your starting point. If you're tired of feeling stuck or overwhelmed by investing, these could be your game changer. So, if you're serious about taking control of your money, smash that like button and subscribe for more tips. Speech balloon comment below. Today I start building my financial freedom. And let me know, are you watching this from the US or somewhere else? I'd love to see how far this message is reaching. Now, let me show you why this is so urgent and what you need to know before starting. In this video, we're going to explore why everyone should consider owning these 3 essential ETFs and how they can transform your financial future. Whether you're just starting out or looking to refine your investment strategy, understanding these ETFs can be a game changer. We'll break down what they are, why they matter right now in the current U.S. economic climate, and how they can help you build wealth, reduce risks, and accelerate your path to retirement. Right now, with inflation concerns, fluctuating markets, and uncertain economic policies, having a solid investment foundation is more critical than ever. These ETFs are accessible to all levels, beginners, intermediates, and even more experienced investors, making them a smart choice for anyone looking to take control of their finances. By the end of this video, you'll know exactly which ETFs to focus on, why they are vital in today's economy, and how to incorporate them into your investment plan with confidence. If you're serious about clarifying your financial next steps in the US, hit that subscribe button right now. And if you find value in this content, click the thanks button below. It helps us reach more people who need this guidance. But to make smart decisions, you first need to understand the economic landscape we're dealing with. In today's complex economic environment, understanding the macro forces shaping the markets is essential for making smart investment decisions. Currently, the U.S. is experiencing persistent inflation, which as of the latest data from the Federal Reserve, stands at around 4.2% year over year. This sustained inflation has prompted the Fed to raise interest rates multiple times, with the federal funds rate now between 5.25% and 5.5%. Higher interest rates can slow economic growth and increase borrowing costs, impacting everything from housing to corporate profits. Inflation erodes purchasing power, making it crucial to invest in assets that can outpace rising prices. Meanwhile, the housing market remains volatile. According to the Bureau of Labor Statistics, housing costs have increased by over 8% in the past year, adding further pressure on household budgets. Tax policies and potential reforms also influence market cycles, creating uncertainty for investors. All these factors, rising rates, inflation, and market volatility, highlight the importance of diversifying across resilient sectors. During economic cycles, certain ETFs tend to perform better, offering a buffer against downturns. By understanding these macro trends, investors can better position themselves to protect wealth and capitalize on opportunities. If this overview is helping you see the bigger picture more clearly, go ahead and like the video. It really helps more people find this content. With that context in mind, let's break down the strategy you can actually apply. Investing in ETFs or exchange-traded funds is a smart way to build a strong and resilient portfolio. Think of ETFs as baskets of different investments, like stocks, bonds, or commodities that you can buy all at once. Instead of picking individual companies, investing in these baskets allows you to spread your money across many assets, reducing risk and increasing potential returns. The main idea behind owning these 3 specific ETFs is to follow a straightforward strategy. Diversify your investments across different sectors and asset types to protect against market ups and downs. For example, one ETF might focus on large, stable companies, another on emerging industries, and a third on bonds or fixed income assets. By combining these, you create a balanced approach that can perform well during various economic conditions. The process is simple. You choose these ETFs based on your financial goals, purchase shares through your brokerage account, and hold them over time. As the market fluctuates, The value of your ETFs will go up and down, but because they contain many different investments, your overall risk is lower than investing in just one company or sector. Key terms to understand are diversification, spreading your money across multiple investments to lower risk, and asset allocation, deciding how much of your portfolio to put into different types of assets based on your goals and risk tolerance. Owning these ETFs helps you stay invested regardless of market changes, making it easier to stay on track toward your financial future. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you decide to invest in 3 popular ETFs, one tracking the S&P 500, another focused on emerging markets, and a third in dividend-paying bonds. You start with a $10,000 initial investment, splitting it evenly among the 3. Each ETF has an expense ratio of about 0.1%. Over the next 10 years, the S&P 500 ETF averages a 7% annual return, the emerging markets ETF about 9%, and the bond ETF around 3%. Using a compound interest calculator, your initial $3,333 invested in the S&P 500 ETF would grow to roughly $7,846. The emerging markets ETF, also starting at $3,333, would grow to about $8,890, thanks to its higher return. The bond ETF, with the same starting amount, would grow to approximately $4,460. Adding these together, after 10 years, your total portfolio would be worth around $21,196, more than double your initial investment. This diversification spreads out risk. If the stock markets stumble, the bond ETF can provide stability, while the emerging markets offer growth potential. Now, imagine you're paying a mortgage of $1,500 a month. If you had invested that money instead, with consistent contributions and the same growth rates, your investment could significantly boost your savings over time. Tools like Zillow or MortgageCalculator.org help you understand your cash flow needs. This looks great, but only if you avoid the common traps that ruin deals like this. Everyone should consider owning these 3 essential ETFs to build a resilient and diversified portfolio. But even with the best intentions, many investors stumble into common pitfalls that can derail their success. Today, I want to highlight some of these critical mistakes so you can avoid them and stay on track. First, one of the biggest errors is neglecting proper research before investing. I've seen people buy ETFs just because they heard about them or because they sound popular without understanding what they actually hold. This can lead to unexpected risks. Always do your due diligence. Know what the ETF invests in, its expense ratio, and how it fits into your goals. Second, many investors fall into the trap of emotional investing, buying high during market euphoria or panicking and selling during downturns. I remember a friend who sold his investments during a market dip, only to miss the subsequent recovery. Staying disciplined and sticking to a plan helps prevent impulsive decisions that can cost you. Third, overlooking the importance of diversification is a common mistake. Relying too heavily on one asset class or sector can expose you to unnecessary risk. Using ETFs that track the S&P 500, emerging markets, and bonds, for example, balances growth potential with stability. By avoiding these mistakes, you set yourself up for smarter investing and better long-term results. Speech balloon, have you made, or almost made, any of these mistakes before? Drop in the comments. You're not alone, and your experience might help someone else. To avoid those pitfalls, here are the best tools and resources available right now. Investing wisely starts with the right tools. Whether you're a beginner or an experienced investor, having accessible platforms to inform your decisions is essential. First up is Yahoo Finance, a comprehensive site offering real-time market data, news, and analysis. It helps you stay updated on the ETFs, tracking the S&P 500, emerging markets, and bonds, ensuring your choices align with market trends. Next is Morningstar, known for in-depth fund research and ratings. It allows you to evaluate the performance and risk profile of ETFs, supporting a disciplined, research-driven approach. Third, platforms like Robinhood and E-Trade provide user-friendly interfaces for buying and managing ETFs, making it easy to diversify your portfolio with just a few clicks. For financial planning, sites like Personal Capital offer tools to track your investments, analyze asset allocation, and plan for future goals. Lastly, Zillow and MortgageCalculator.org are invaluable for understanding how your investments can support homeownership or other major financial decisions, integrating your investment strategy with real-life goals. Which of these tools are you already using, or which one are you most excited to try? Drop a comment below. I'd love to hear your thoughts. Now that you've got the tools, let's talk about the first step you can take today to start building a resilient, diversified portfolio. Imagine a simple way to start building your financial future today. You don't need hours or a lot of money, just 15 focused minutes. One small step can unlock a world of progress. For example, why not check your credit score right now? It's quick, free, and gives you a clear picture of where you stand. Or download a user-friendly investing app like Robinhood or E-Trade to see how easy it is to buy ETFs. You could even take a moment to list your monthly expenses. Understanding your finances makes it easier to save and invest. Or simulate investing in 3 key ETFs, those that track the S&P 500, emerging markets, and bonds. This quick exercise shows you what's possible and builds your confidence. Taking this first step creates momentum. It's the foundation for smarter decisions and consistent progress. Remember, most people never start because they think it requires hours or lots of money. But just 15 minutes today can change your direction. Do just one small action now, because taking that first step is how every long-term success story begins. Let's look at what happens when you stay consistent. Your future self will thank you for the small effort you make today. Imagine yourself 5, 10, or even 30 years from now. Picture the savings you've accumulated, the investments that have grown, and the financial freedom you've built. It might seem distant, but the truth is small, consistent contributions today can turn into something substantial over time. For example, consistently investing in just 3 simple ETFs, covering the S&P 500, emerging markets, and bonds, can leverage the power of compound growth. Over decades, your investments can multiply, not through luck or quick wins, but through steady, disciplined action. Take a modest $200 monthly investment. With average market returns, that amount can grow to over $100,000 in 30 years. It's not about overnight riches. It's about the steady, reliable process that builds wealth quietly in the background. Every contribution, no matter how small, adds up. The key is consistency, showing up day after day, month after month, year after year. Over time, these small steps lead to significant progress. And now that you see what's possible, here's how we wrap this up and take action. If you followed along this far, you're already way ahead of the average person financially. The only thing left is to decide. Will you keep going consistently? Remember, the power of long-term investing isn't in one big move, but in persistence. Start today, stay committed, and watch your future transform. Remember, the key to building lasting wealth is consistency and smart investing in diversified ETFs. By choosing these 3, covering global markets, emerging economies, and fixed income, you're setting yourself up for steady growth over time. Small, regular contributions can grow into a sizable nest egg, thanks to the power of compounding and disciplined habits. You've already taken a big step toward financial independence, so keep that momentum going. Thanks so much for watching and for your commitment to smarter money choices. Remember, progress is a journey, not a sprint. If this video helped you see investing in a new light, hit the like button and subscribe. This channel is all about practical clarity without any fluff. And I'd love to hear from you. What's your first financial goal for the next 12 months? Drop in the comments below. Before you go, check out the next video where I share tips on making the most of your first paycheck or tax refund. Stay focused, stay consistent, and I'll see you in the next one.